Introduction to money printing. In 2008, the global financial system faced a severe crisis that caused the normal flow of money to stop. Banks no longer trusted each other, lending between institutions slowed down, and businesses struggled to access credit. This created a chain reaction that began to affect the entire global economy. As financial markets froze, central banks around the world were forced to step in and search for new solutions. Traditional tools, such as lowering interest rates, were no longer enough to stabilize the situation. This moment marked the beginning of a completely new monetary era. Central banks started using unconventional policies to inject money directly into the financial system with the goal of restoring liquidity, rebuilding confidence, and preventing a total economic collapse. What is QE? Quantitative easing, or QE, is a monetary policy where central banks purchase large amounts of financial assets, mainly government bonds and other securities. The purpose of these purchases is to increase liquidity in the financial system. When central banks buy these assets, they create new money electronically and inject it into the economy. This increases the amount of available capital, making it easier for banks to lend and for businesses and consumers to borrow. At the same time, QE expands the balance sheets of central banks significantly. This process also helps lower interest rates and supports overall economic activity during times of crisis. Global impact. The use of quantitative easing quickly spread across the world. The United States was one of the first to implement large-scale QE programs in response to the financial crisis. These actions helped stabilize markets and restore confidence. In Europe, the situation developed differently. The European Central Bank introduced not only asset purchases, but also negative interest rates. This meant that banks were effectively charged for holding excess reserves, encouraging them to lend more. Japan took yet another approach by introducing yield curve control. This policy allowed the central bank to directly influence interest rates across different time periods. Together, these global actions reshaped the financial system and defined the modern era of central banking. Dot-com era. In the late 1990s, the world experienced a rapid expansion of technology companies, known as the dot-com boom. Investors were highly optimistic about the future of the internet, and massive amounts of money flowed into tech stocks. Many companies had little to no real profits, yet their valuations kept rising based on expectations rather than actual performance. Eventually, this bubble burst. Stock prices collapsed, many companies failed, and investors lost significant amounts of money. To stabilize the economy and encourage recovery, central banks responded by lowering interest rates. This made borrowing cheaper and aimed to stimulate spending and investment once again. Mortgage boom. Low interest rates made credit easily accessible to both individuals and businesses. This led to a rapid expansion in the housing market as more people were able to take out mortgages. Banks began issuing increasingly risky loans, including subprime mortgages to borrowers with lower creditworthiness. At the same time, these loans were packaged into complex financial products and sold to investors, a process known as securitization. While this seemed efficient and profitable, it also spread risk throughout the entire financial system. The system appeared stable on the surface, but underlying risks were growing rapidly. System collapse. When borrowers started defaulting on their mortgages, the weaknesses in the system became clear. Financial institutions began to suffer heavy losses, and trust between banks disappeared. Without trust, banks stopped lending to each other, causing liquidity to vanish from the system. This breakdown triggered a global financial crisis. Markets crashed, major institutions failed, and economies around the world entered a deep recession. The collapse revealed how interconnected and fragile the financial system had become, and it set the stage for the introduction of extraordinary monetary policies like quantitative easing. QE1. After the 2008 financial crisis, central banks needed to act quickly to prevent a complete collapse of the financial system. The first round of quantitative easing focused mainly on the purchase of mortgage-backed securities, which were heavily affected during the housing crash. By buying these assets, central banks helped stabilize banks and restore confidence in the financial system. This also injected liquidity into the economy, allowing financial institutions to continue lending. The primary goal of QE1 was to support the financial system and prevent a chain reaction of failures across banks and businesses. QE2. Even after the initial intervention, the economic recovery remained weak. Growth was slow, unemployment stayed high, and there were increasing concerns about deflation, which can slow down economic activity even further. To address this, central banks introduced QE2, which involved additional large-scale purchases of government bonds. This increased the money supply and pushed interest rates even lower. Lower rates encouraged borrowing, spending, and investment. The focus of QE2 shifted from emergency stabilization to actively supporting economic growth and preventing long-term stagnation. QE3. The third phase of quantitative easing introduced a more flexible approach. Instead of committing to a fixed amount of asset purchases, central banks implemented open-ended programs. This meant they would continue buying assets for as long as necessary to support the economy. This approach was often described as whatever it takes, signaling strong commitment to maintaining stability. QE3 provided long-term support to financial markets, kept borrowing costs low, and helped sustain investor confidence over time. European measures. In response to ongoing economic weakness, the European Central Bank introduced a range of unconventional monetary policies. One of the key actions was the implementation of large-scale bond buying programs, similar to quantitative easing used in other parts of the world. In addition to this, Europe introduced negative interest rates. This meant that commercial banks were charged for holding excess reserves at the central bank, which encouraged them to lend more money instead of keeping it idle. These measures were designed to stimulate economic growth, increase inflation, and support stability within the Eurozone, especially in countries that were hit hardest by the crisis. Japanese approach. Japan adopted a unique and long-term approach to monetary policy. It introduced quantitative and qualitative easing, also known as QQE, which combined large-scale asset purchases with additional policy tools. One of the most distinctive strategies was yield curve control. This allowed the central bank to directly manage interest rates across different maturities of government bonds, ensuring they remained low. Japan also faces extremely high levels of government debt, making these policies even more important. The overall goal has been to maintain economic stability, support growth, and avoid deflation over the long term. Practical meaning. In practical terms, these policies involve central banks exchanging bonds for reserves. Financial institutions sell bonds to central banks and receive newly created money in return. This process significantly expands the balance sheets of central banks and increases the amount of liquidity in the financial system. At the same time, it pushes interest rates lower across the economy. Lower interest rates make borrowing cheaper, encourage spending and investment, and support asset prices. However, while these effects can stimulate growth, they also introduce long-term risks that need to be carefully managed. Real estate. One of the most visible effects of low interest rates and quantitative easing can be seen in the real estate market. As borrowing becomes cheaper, more people are able to take out mortgages, which increases demand for housing. This growing demand pushes property prices higher over time. While this benefits existing homeowners and investors, it also creates higher entry barriers for new buyers, especially younger generations. As prices rise faster than incomes, affordability becomes a major issue. This leads to a situation where owning property becomes increasingly difficult, and inequality between those who own assets and those who do not continues to grow. Stock markets. Stock markets have also been strongly influenced by these monetary policies. With low interest rates, investors are more likely to move their money into stocks in search of higher returns. This increases demand for equities and pushes valuations higher. In many cases, stock prices rise even when company profits do not grow at the same pace, creating a disconnect between market value and real performance. As a result, speculation becomes more common. Investors take on more risk, and markets become more sensitive to changes in policy or economic conditions. Savings for savers, the environment of low interest rates creates significant challenges. Traditional savings accounts offer very low returns, often below the rate of inflation. This means that over time, the purchasing power of money decreases. People who rely on savings lose value instead of preserving it. Because of this, many individuals are forced to look for alternative ways to protect and grow their wealth. This includes investing in stocks, real estate, or other assets, often with higher levels of risk. Role of gold. In an environment of uncertainty and aggressive monetary policies, gold becomes a more attractive asset. Unlike currencies, gold cannot be printed, which gives it a sense of stability and long-term value. Investors often turn to gold as a form of protection against financial risk, inflation, and currency devaluation. It is also unique because it carries no counterparty risk, meaning its value does not depend on the performance of a company, bank, or government. Because of these characteristics, gold is often seen as a safe haven during periods of economic instability and market volatility. New normal. Over time, these policies have created what many call a new normal. This environment is defined by consistently low interest rates, high levels of global debt, and ongoing central bank intervention. In such conditions, borrowing becomes easier, and both governments and companies take on more debt. At the same time, investors are encouraged to take on more risk in search of higher returns. While this supports economic activity in the short term, it also creates long-term challenges that may not be immediately visible. Hidden issues. Beneath the surface, several hidden risks continue to grow. Corporate debt levels have increased significantly as companies take advantage of cheap borrowing. Investors are also exposed to higher levels of risk, often without fully realizing it. Markets may appear stable, but this stability is heavily supported by central bank policies. This raises important questions about long-term sustainability. If conditions change or support is reduced, the financial system could face new periods of instability. Pandemic 2020. In 2020, the global economy came to a sudden stop due to the COVID-19 pandemic. Businesses closed, travel was restricted, and entire industries were put on hold almost overnight. In response, central banks acted faster than ever before. They introduced massive monetary support programs to prevent economic collapse. Liquidity was injected into the system on an unprecedented scale, ensuring that financial markets continued to function. This rapid reaction helped stabilize the situation, but it also significantly increased the amount of money in the global economy. Policy actions. To support economies during the pandemic, central banks implemented extremely aggressive policies. This included effectively unlimited quantitative easing, where asset purchases were no longer restricted by a fixed amount. Governments also stepped in with fiscal stimulus, providing direct support to businesses and individuals. This included subsidies, loans, and financial aid programs designed to keep economies running. Together, monetary and fiscal policies work to maintain stability, support employment, and prevent widespread bankruptcies. Effects. The effects of these actions were immediate and significant. Financial markets recovered بسرعة, even while the real economy was still struggling. At the same time, the money supply expanded rapidly, reaching levels never seen before. This created new dynamics in the economy. One important concept that emerged is the cantillon effect, which describes how newly created money benefits those closest to the financial system first. This can lead to increased inequality as asset holders gain more than others. Inflation returns. After years of low inflation, prices began rising again. Energy costs increased significantly, food became more expensive, and everyday services started to cost more. This rise in inflation was driven by multiple factors, including supply chain disruptions, increased demand after the pandemic, and the large expansion of the money supply. As a result, the cost of living increased, and many households began to feel financial pressure. Central bank response. To control inflation, central banks changed their approach. Instead of supporting the economy with low interest rates, they began raising rates rapidly. Higher interest rates make borrowing more expensive, which slows down spending and investment. This helps reduce inflation over time. At the same time, central banks started tightening monetary policy by reducing asset purchases and shrinking their balance sheets. Consequences. These policy changes had immediate consequences. Loans became more expensive, making it harder for individuals and businesses to borrow money. Financial markets reacted with increased volatility, and many asset prices began to correct after years of growth. In this environment, gold regained importance as a store of value. Investors once again looked for assets that could protect against uncertainty and inflation. Gold in portfolios. Gold plays an important role in investment portfolios, especially during times of uncertainty. It is often used as a form of protection against market volatility, inflation, and currency devaluation. By including gold in a portfolio, investors can achieve better diversification. This means that not all assets react the same way to economic changes, reducing overall risk. Over the long term, gold is valued for its stability and its ability to preserve wealth across different economic cycles. Real examples. In real life, many individuals and businesses turn to gold as a way to protect their financial position. Some people choose to save a portion of their wealth in physical gold to guard against inflation. Businesses may also use gold or other hard assets as part of their long-term survival strategies, especially in uncertain economic environments. Analysts often observe that during periods of crisis or instability, demand for gold increases as confidence in traditional financial systems weakens. Investment strategy. A balanced investment strategy typically involves a mix of different asset types. This can include stocks, bonds, real estate, and commodities like gold. Regular investing over time helps reduce the impact of market fluctuations and lowers overall risk. It is also important to monitor interest rates as they have a strong influence on asset performance. By combining diversification, consistency, and awareness of economic conditions, investors can build more resilient portfolios. Dark side. While these policies helped stabilize the economy, they also created several negative side effects. One of the most important issues is the survival of so-called zombie companies. These are businesses that are not profitable but continue to operate because borrowing is cheap and financing is easily available. At the same time, systemic risks remain hidden beneath the surface. Markets may appear stable, but this stability often depends heavily on continued support from central banks. Another consequence is growing inequality. Those who own assets, such as stocks or real estate, benefit the most from rising prices, while others fall behind. Gold versus Bitcoin. Gold and Bitcoin are often compared as alternative assets, but they are fundamentally different. Gold has a long history as a store of value and is widely trusted across the world. Bitcoin, on the other hand, is a relatively new digital asset. It has a limited supply, similar to gold, but it is much more volatile and less stable. While both can be used as a hedge against traditional financial systems, they serve different roles. Gold is typically seen as a safe and stable asset, while Bitcoin is considered more speculative. Key lesson. The key lesson from all of this is that the amount of money in the system can grow much faster than real economic value. This creates imbalances and shifts wealth toward those who own real assets. As a result, protecting wealth becomes increasingly important. Investors need to understand how the system works and adapt their strategies accordingly. In a world of constant monetary expansion, assets like gold and other real investments play a crucial role in maintaining long-term financial stability.